This lesson is going to introduce moving averages, both the simple moving average and the exponential moving average. So what are they? They are the lines on the chart that go beneath price along these bands. So on the chart on the screen, we have a 50 moving average, a simple moving average, and we have a 50 exponential moving average. So the blue is EMA, the red is MA. So what are they? A simple moving average, the MA, is a calculation where you take a number, so let's say it's 50 in this example, you take the last 50 candles and then you divide the closing prices for each of them by 50. So by taking the closing price of the last 50 candles, dividing it by 50, you get a number, and that number gets plotted with every new candle, and it makes, over time, a band. Why does it matter? Well, generally traders want to see, with whatever time frame, if price is above the band, they can consider it to be bullish. If price is below the band, they can consider it to be bearish. In its fundamental sense, that is the entire purpose of moving averages. The difference is that a MA, a simple moving average, is a smooth average of the prices. So just add them all up and divide by the number. The EMA is weighted and gives greater weight in the calculation to recent prices. So that means that EMAs will react faster to price changes, while moving averages will react in a smoother manner. So if you're a shorter term trader, you might want to utilize EMAs to capture turning points or identify trend shifts sooner. You can see on the chart that at the bottom and at the top, so at the two turns of this trend, the EMA turned up and was moving positive earlier than the MA, and on the downside, the EMA flipped into a downtrend earlier than the MA. That's an idealized example, but that is showing you how the EMA can benefit over the MA. But key MAs, key moving averages, have more relevance to more traders across the market, especially on the specific 50, 100, and 200 period moving averages, especially the 50 period daily moving average, the 100-day moving average, and the 200-day moving average. Those are just commonly accepted. It's conventional wisdom. They're widely accepted in the market. And as you know from previous lessons, a lot of what the market believes will dictate where price goes. You don't want to use patterns or indicators or data that nobody else has, because then nobody else will see relevance in it. You want to make sure you're using things that other people do see and avoiding being in too much of a crowded trade. That's where the little bit of context needs to be added. Right? So personally, I use exponential moving averages for trading. And in the next lesson, I'm going to show you exactly how I use EMAs to trade. If you want to use moving averages, you absolutely can. There's nothing wrong with them. I keep them on my chart and I use them for higher time frame analysis. It's always good to see where your coin is in relation to the 50, 100, and 200-day moving averages. And for large moves, you can even look at 50-week, 100-week, 200-week moving averages. But day-to-day, to actually trade, I want to use bands, EMA bands, and specifically 2 EMA bands that I trade with crossovers and for trend following. So go to the next lesson and you'll see how I use those.